We're back on. And yeah, so we had a good time. And anyway, all right. So this week I'm going to keep it short because it's a holiday weekend, and I know I don't have any friends here, and that doesn't surprise me. But I'm going to show you two videos that I've created on the capital asset pricing model. Now, I did give you these videos in my announcements, but I think it would be helpful if we watch them together. So this way you understand just how this works and how to find a different, like market rate of return and everything else. So give me a second. I just want to share these with you. Great article in today's paper about how AI is upending Google. And it just comes back to the stuff that I always tell my students, that no company, no matter how strong a company looks, it's the nature of business, it's the nature of I teach economics. It's the nature of economics that companies will be upended, that there will be companies will be upended at one point. There will be competitors. Whenever there's a lot of capital to be. All right, so let's watch this together. Give me a minute. I want to set it up so you hear everything. Share. Share. Okay. Okay. Here we go. A video or a review of the capital asset pricing model. It's a comprehensive review, I like to call it. Of course, this is in my. I gave you the links to this if you want to watch it again. Bear with me 1 second. Excuse me. Okay, here we go. It's the capital asset pricing model is a very elegant solution to finding the proper discount rate when valuing equities or any free cash flow sequence. So one of the things that we learn about in finance is the ability to take a series of cash flows, whether they are free cash flows, which we could talk about in further video, or whether that's EBITDA, of earnings before interest, taxes, depreciation, and amortization, and any type of positive cash flow, and discounting it back to find a value today, almost like the way you'd find the value of a bond. So as important as that is, you need a discount rate. You need a proper discount rate. And the capital asset pricing model is the most elegant in that it incorporates a number of theories and market. It's actually, what I like about it is it reflects the activity that exists in the equity markets. So it's not just theoretical in nature, but also a reflection of what investors truly feel when they create an equilibrium in the markets. But there are a number of assumptions that are made, and it assumes that investors are rational and risk averse. So that means that an investor will value a company's assets based on a very rational and risk neutral set of assumptions, which we know that over the last number of years, with the advent of more acceptable theories in terms of behavioral economics, that investors are not always rational and risk averse, that they are driven by a number of emotional responses, such as framing or risk aversion, or where they will prize an equal gain much more than an equal loss, or will they frame a risk in terms of. So these are the assumptions we would make with the capital asset pricing model. One is that it will indicate to us the required rate of return on equity. So how much our stock, the investors of our company who buy stock, are actually requiring. So the more risk
in the stock, the higher the rate of return, and that's going to be the cost to us, because effectively what they've done is they've said, you're like say for instance Coca-Cola might have a required rate of return of only about 5 or 6%, as opposed to the safest rate of return, which is the U.S. government about 4.5%, because people don't expect Coca-Cola to have a lot of volatility or worry about their earnings. But on the other hand, something like Tesla or a biotech company, investors might require a 10 or 12% rate of return, in which case they're going to sell the stock. If they don't get that return, they're going to sell the stock, um, uh, sell the stock till it gets to a price that gives them that return. They're going to adjust the price of the stock essentially. If they like a stock, it's like if you have a McDonald's, if you want to open up a hamburger restaurant, and you either decide to do it on your own and take the space locally and buy all the goods and hire a chef, or you do it yourself, or buy a McDonald's, the rate of return if you succeed on your own restaurant is going to be 35%. The rate of return in a McDonald's is only about 12 or 13%, but the bit difference is the risk. Since the McDonald's is pretty much does all the advertising for you, gives you the system, does everything else, you have to pay more for that. And when you pay more, you get a lower rate of return. Whereas in your own business, you're going to save a lot of those costs, but you have the risk. And it's the same thing with a stock. When people are worried about a stock, or they think that it requires a higher rate of return, the price of the stock is going to go down, and that's going to account for. It's like when you go to buy a used car, you're not sure. Maybe it says the car is worth 9,000 or 10,000, but when you get in there, you still don't know if the car is going to be good because it's used. It's not new, so you might pay 8. There's going to be a discount because you're uncertain, and if it works out, you get a better rate of return, and that's the same thing. And if it doesn't, you've adjusted your sights. That's what investors do when they have asymmetric information, or information that they don't think is the same as what's going on there, and they have no way of verifying that. Well, then in that case, they're going to be more aggressive in terms of how they value the stock. So the capital asset pricing model it accounts for the difference between how your stock, any particular stock acts, and how the general market acts. And that's going to give the markets, it's going to give the model, the idea. It's a simple model, but you can build off of it, and we have built off of it. But in this simple model, you start to see how um, you can figure out the cost of equity, what the investors are demanding for equity. Because if you don't meet that cost, they're going to sell your stock down. For years, Coca-Cola stock wasn't doing well until a chairman called Bob Gozzietta came in, and he had a good background in business. And he said, well, what's the capital asset pricing model telling us? And he was finding out that their cost of equity was a lot higher than what they were assuming, and that was killing their stock. So let's keep watching. And these are all the assumptions you make. You have to make assumptions, obviously, or the model doesn't work.
Of previous experience,
and just another point: the assumptions are pretty rigorous, and they're not always applicable. But the bottom line is, overall, the model gives us a good indicator. It's not perfect, but it gives us a very good indicator. And then we can add other variables to it, which we have. Fama French is two famous researchers who added other variables to the model. So they weren't looking at the difference between the stock and the market, but they were looking at other things like value versus growth stocks and things like that. They were adding other variables to make it more refined.
Or they will more cherish information that is obtained previously than information that they learned about a week ago or a month ago. There's a number of these theories, and with the Nobel Prize being won by Richard Thaler this year, he was a famed or a leader in the canon of behavioral economic thought. These assumptions start to become kind of challenged in financial theory, but we assume that at any rate because we need an assumption and a starting point for this. We also assume that investors are price takers and cannot influence the price of a stock. That means that the supply-demand dynamic that exists within the markets where Microsoft or IBM or Apple trade constantly, that is just a function of where thousands and thousands of investors and billions of dollars have decided that the supply-demand paradigm should create the price, and not that any one influencer could move the stock too much and kind of throw out the theory that this is an independent view of many investments. Finally, we assume that that when we talk about the risk-free rate, which we'll talk more about in a minute, that you have immediate liquidity using the risk-free rate. That in this case, it's the 10-year Treasury, and that represents a true risk-free rate, and that there is immediate liquidity, and also that one can trade with.
That's important to realize that with the you have to have true liquidity, right? You have to have, and you have to always beat the risk-free rate, because if we can't beat the risk-free rate, if an investment doesn't beat the risk-free rate, then why would I invest? I'll just put the money in government securities. So that's another very important facet of the capital asset pricing
without friction. So that means that we don't factor in the possibility of that there will be commissions, or that the markets will not be readily tradable and not liquid. So these are the assumptions of using the capital asset pricing model. In our next video, we're going to go over the formula, and we'll start to talk a bit about how the formula breaks down.
I noticed here's the formula. It's the risk-free rate plus the beta. Now, the beta you could find on Yahoo Finance. The beta you can find on Yahoo Finance. I'll show you how to do that. Times the risk of the market, which is essentially the risk of the S&P 500. And how do we find that? We just have to find, and you can find it on the Wall Street Journal, you just have to find the price earnings ratio. How much are people paying? How much are investors paying for a dollar worth of earnings? Now, on the S&P 500, right now they're paying about $20 for approximately $20 for every dollar of earnings. Now, some stocks trade a lot higher, like Nvidia or Tesla, and some trade a lot lower. So, but on average, the S&P 500 is basically a very good indicator of American industry. And if you look at it as a whole, it's about 20 times earnings. So that's a good starting point, because it's a diversified portfolio. Well, if you're paying $20 for a dollar of earnings, then a dollar divided by 20 means you're getting a 5% earnings yield. So the return on the market that's being expected is about 5%. So when you take the return on the market, which is about 5%, minus the risk-free rate, which is the 10-year bond, which you'll see in the next video, which is about 4.5%, you're getting about 0.5% for buying equities. We call that the equity risk premium. And to tell you from the professor's standpoint, I don't think that's a hell of a lot. It's really not a lot. It's only 0.5%. That concerns me about the markets right now. Now, one could argue that the markets will grow and can justify those high values. But my feeling is a lot of people are reaching for stocks right now. They're not getting enough. Inflation has gone up. The cost of living has gone up for a lot of retirees who have a lot of investments. And I'm fearful that now younger people generally are in companies, and they generally just buy funds that the companies offer in their 401k, which is great for the markets. That's one to me is a blessing for the markets, because you're almost forced to not do anything foolish and just buy the regular funds. But a lot of older people, when they can control their portfolio and then they start trading on their own, they tend to think, well, I can be smarter than the markets. And you really can't. The markets are a random walk. It's very difficult to outtrade the markets. As a matter of fact, it's almost to me impossible, because you're always getting new information every day. How are you going to know what the new information is? I mean, I saw an article in today's paper where they say that Google, and it's a fascinating article, where they say, I'll probably add it to our class this week. Google is actually having a real problem now. And we think about it, 4 or 5 years ago, it was the only place to search. Now with AI and different AI search engines, people are not using Google as much. And this kind of hurts them, not just because people stop using it, but other companies that make platforms that work with Google start making platforms for other places. The platforms go, it's like apps for a phone. The apps and the platforms go where the business is. If you have the place where everybody's going, almost like a town square, let's say think about it this way. The city, I grew up in New York City. So the New York City area was a vibrant, big business area. Because it's so big and vibrant, and so many people live and work here, other businesses get built around it in New Jersey and Connecticut and the boroughs on Long Island. All these things, and in any of the big cities, all these things happen because of New York. But if all of a sudden tomorrow nobody wants to be in New York, like for years, Pittsburgh was a wealthy area because of steel, and other things happen. Then all of a sudden they made steel more efficiently in other places. And when that industry goes, people leave. I guess my point is, when you have this big business, other businesses will build around it. But obviously, um, when the business goes south or just isn't as competitive, you're going to lose those ancillary benefits, okay, and that's really my point. All right, so let's take a look at part two of the capital asset pricing model, and this will kind of bring it home.
Okay, this is my second video in the series of discussing the capital asset pricing model. And in this particular case, we're looking at the formula that underlines the capital asset pricing model, which is the risk-free rate plus the beta. And what is beta? Beta would be the relationship between an individual stock and the overall market. So how do we calculate beta? And we'll talk more about this in the series of videos, is that we do a simple regression like you learned in high school algebra, where we look at the returns on a particular stock versus the returns on the overall market. And then we multiply that by the risk of the market, which is the overall return we would get by investing in the general market minus the risk-free rate. So it's simple, but it makes a lot of sense. And where a CAPM is the capital asset pricing model, a price for a particular stock, RF is the risk-free rate, B is the beta, and RM is the market risk. And the capital asset pricing model was developed in the early 1960s by William Sharpe, who was famed for the Sharpe ratio. We'll talk about that in future videos. Jack Traynor, John Lintner, and Jan Mosen. And it's based on the idea that not all risks should affect asset prices. And underneath you see a citing if you want to go and look at their original paper, which is interesting. If you're an academic, I would certainly pay attention to it. So that's the formula. I'm sorry for moving this around, for the CAPM. What is the risk-free rate? Well, first of all, you have to earn the risk-free rate before you decide to take risk. A rational investor, not all investors are rational, but a rational investor would obviously want to take a return that has no risk before they would introduce risk into their portfolio. So the markets generally assume that the 10-year U.S. Treasury bond is the risk-free rate, and that it's riskless. And why is that? Is that the U.S. government is assumed to be the safest investment on the globe in terms of risk, and they borrow at the most efficient rate, considering all things considered, which are inflation and length of time and all the things that go into bond risk. The U.S. government has the lowest rate. That's a conversation for another day. But why is the U.S. government, why is that? Well, first of all, we have constitutional protection. So when you enter an agreement with the government or with any bond, or lend money to any lender, there's a document in terms of a bond called the indenture, and that's the contract that governs the loan. And if either party runs afoul, and most notably the lender runs afoul, then you can go to court, is the bottom line, and courts will recognize it and they will act on it. So you have constitutional protection, and which may not exist in other countries. We also have the Federal Reserve that guarantees us monetary.
This is basically why the government has the risk-free rate, okay?
Stability, which is the dual mandate of the Fed to have steady and sustainable employment, as well as a stable currency, which means it's protected against inflation. So we have a Fed that is constantly on the lookout for inflationary signals, or even takes action in a recession for deflation. So the global actors or investors are aware of that, and they consider the U.S. government to be the risk-free rate. And lastly, we have a stable political situation. Again, you can notice in many countries, in particular today in places like Venezuela, the governments do not seem stable. Well, here we have a trilateral government. This isn't a civics lesson, but we have a president, we have an executive branch, a legislative branch, a judicial branch, and they are checks and balances, and that creates a stability. So all of these things go into the factors that kind of deem the U.S. Treasury as a safe investment. And where do we find that quote? I took a brief screenshot, and that's from the Wall Street Journal. And this was as of.
So when you go to the Wall Street Journal and you go to the top of the Wall Street Journal, what you're going to see is a page that you can always find this anywhere. Anywhere you can find the 10-year Treasury, which you will find in the Wall Street Journal, you'll find in MSN Money, you can find anywhere. That's going to give you the place where you could look for the 10-year Treasury. And it's very available. I mean, as finance majors, you always want to know where that is. And right now it's about 4.25, 4.75, like that. It's been like that for a while. So just be aware of that. That's where you're going to find all of that information. Okay, you'll find it in the Wall Street Journal. Maybe I could just stop sharing for a minute. Give me 1 second. See if I could show you this. Okay, I'm going to share my entire screen. Okay. And the Wall Street Journal is here. You can call up that, and it's going to always be right on this ribbon up here. Bear with me. I don't know why it's not coming up. Well, let's do Let's do Yahoo Finance. That's probably better. Let's do Yahoo Finance. So we'll go to Yahoo Finance. And maybe because it's a Saturday, it doesn't come right up. But if you go to the right of Yahoo Finance and you go to rates, you'll see there's the 10-year bond. And the 10-year bond right now is 4 3/8. So about 4.5. You do that. That's the 13-week Treasury bill. Well, I'm going to get the 10-year. Some people use the 10-week Treasury because they feel that's short term. I like to look at the 10-year bond. I feel that's more indicative because that gives you a longer term look. Because one thing about the capitalistic pricing model, things do change. So it's about the same. You know, the 10 years is a little higher. The 13-month or the 1 year is a little higher. Okay. Let's go back here. So I'm going to go back now. And ultimately, what happens is, just give me 1 second. Now you just have to find the return of the S&P 500, right? And that would kind of wrap this up for you. So I'm just going to go here for a minute. And so how do I find that? And that's my next question, right? How do I find that? So bear with me 1 minute. Oh, playlists. So I'll show you where to find it. So at any rate, you go to the Wall Street Journal, and I'm giving you the numbers basically. But if you go to U.S. stocks, and even if you don't have, I urge you to get a subscription. But even if you don't have a subscription, you should be able to find this. And you go to the right, and you go to Index Ps, and that's going to be the S&P 500. So you go right there, and you could see that the S&P 500, which is right here, it's about 20 times a year ago. I'm going to use 20 times. I feel more comfortable with that because I can't believe that we're almost at the same rate. If I use 25 times earnings, basically what we're getting is the same. You're not getting any benefit in stocks. I can't even get my head around that again. But at any rate, when you've done all those things, you're going to get the rate of return. So essentially, for to wrap this up, and I don't want to take too much time, but to wrap this up, bear with me. That's going to be the capitalistic pricing model. Now, In terms of other stuff that we have to cover this week, and I wanted to cover that because these are the costs. This is your categorization of costs. So you got direct costs, which are costs that are directly transfer or traceable into any of the. So I want to show you this capitalistic pricing model because it helps us to determine the rate of return. It's a little bit of an extra thing I wanted to give you this week. I just wanted to, it's something that you're going to be dealing with in later finance classes. So I want to make sure that you at least got that, right? Now, these are direct costs, right? These are direct costs. These are the costs that go into your company, right? So you can categorize costs. So this is sort of like an accounting class. Indirect costs are costs that are not part of your production, but things like rent, utilities, salaries. And then you get period costs that are like selling and administration costs. So you got three costs. You have the direct costs are the materials that directly go into your manufacturing process, like phone cases or things like that. And then you have your indirect costs, which are associated with specific time rather than the production of goods, like all like the you pay your accountants, your lawyers, you pay people like that. And then finally you have your period costs, which are costs that happen when you make the production of goods, like selling and administrative costs, right? So does it just you have to know the difference between your actual product costs and your indirect costs, right? And how will you determine a break even level? It's not that difficult. So let's take a look. Okay, so they want to know how they have a 40. So you determine your fixed costs, which are the costs that you have if you're not producing any product, and that's going to be $50,000. And your total fixed cost, say 50,000, divided by your unit contribution margin, which is the number of units you need to break even. So you know that you have to make up your fixed costs in order to start making money, right? Because those costs are going to be there whether you produce or not. So if you have $50,000 worth of fixed costs and you want to get to 40,000, I think they wanted to cover $40,000, right? And you're selling, all right, in this case, you want to cover your fixed cost and you're selling your product for $5. If you take your fixed cost divided by $5, that means you have to sell 10,000 sandwiches to just cover your fixed costs. So let's say you had a business, any business you have, you determine what your fixed costs are, which are the costs that you spend, whether you have a business or not, and divide it by your price. And that's going to mean once you sell that 10,000 sandwich, that month, or it depends on how long your fixed costs are. These yearly fixed costs, month. Let's assume they're monthly fixed costs. Once you sold that 10,000 sandwich, you've covered your fixed cost. And now you take the 10,000 sandwiches plus so this $5 represents your profit, not the selling price, but your profit. So even if you're selling this product at $10, $5 is your profit. So it's your variable cost, right? So right, because you're selling it for $10, you have $5 in variable cost, right? That means that's going to move. That $5 in variable costs are going to change with every unit, but the rest is going to be how you contribute, right? Because once I cover my fixed cost, the rest is covers my. Once I cover my variable costs, because every time I sell a product like a pizza, well, the variable cost is going to always go with me, right? Every time I sell a pizza, I still got to lay out $5 of variable cost. But the other $5 is actually starts to reduce my fixed cost and then becomes profit. So once I know my unit selling price, subtract out my variable cost, the rest is going to be how much I contribute. They call it a contribution margin. It could also be just how you're knocking down your fixed cost. So now I take my fixed cost, divide it by that contribution margin. And now I know that once I sell 10,000 sandwiches I'm accounting for my variable cost. I've covered my fixed costs. Now I take my 10,000 sandwiches plus times the price of my each unit minus my I take the 10 I take that I take my 10,000 sandwiches times this is hard to say, the $10 of unit sales price, and that's going to equal my annual revenue. So $100,000 in sales less 50,000 of fixed costs less total variable cost equals no profit, and there's my break even. Because once I figure out, right, because once I take the 10,000 sandwiches, right, times the unit selling price, that's my annual revenue. So once I take my annual revenue and I can prove it, less my fixed costs, less my variable costs, which is the 10,000 sandwiches times 5, that's where I'm at zero profit. So once I hit 10,000, so once I hit that level, I've accounted for everything and I start making profits. And that's how you do the math. So you have 50,000 of fixed cost, right? Let me see if I can make this bigger so we can both see it. Not really. Okay, you can't. So you have 50,000 in fixed costs, right? Plus your 40,000 in profit, because that's the profit that they wanted to get. Divided by the $5 contribution margin means you have to sell 18,000 sandwiches annually to get a $40,000 profit. And 18,000 sandwiches times what you sold it at, which is 180, equals 180 in sales. If I take the 180 in sales, less my fixed costs, because fixed costs never change, less my variable costs, which is the 18 times the 5, you'll notice that when you subtract it out, you get your 40,000 profit. So use this as a guide to determine, use that as a guide when you have to do the math on this. Use that as a guide, okay? And I think that covers us. So I did give you extra work this week. So we determined the break even point. I want to show you one other thing before we finish. So you want to remember your variable costs vary with each unit of production. So say like a pizzeria, it's going to be your dough, your cheese, what it costs the energy to make this thing. Your fixed costs are going to be your rent, your salaries, some of your salaries. Sometimes in cost accounting, some salaries are fixed, some are variable. So for instance, if you're paying an accountant every month, that's going to be fixed. If you're paying people, you have to hire extra people for the weekend, you may consider some of that variable. But you want to always make your cost accounting as accurate as possible so you know exactly the costs that are going to go with you every month, no matter whether you produce or not, and the costs that are going to change with each unit of production. Okay. So this week's keyword is going to be variable. I'm sorry, we're going to make it variable costs. It's going to be variable costs. But once again, use this, go to this thing, this break-even point, and make sure you understand this before you do the work. And once you know once you know you're fixing, once you know your fixed cost, right, and you can cover your fixed cost, that's your break-even point. And depending on, so in this case, they were selling this product for $10. 5 of it was variable, so that's going to go away every time you sell a product. But the other 5 is actually your profit. Once you sold enough sandwiches to knock out your fixed costs, then $5 of every sale afterwards is going to be profit. So try to remember it that way. Okay. And the beginning of this class was the capital asset pricing model. So I want you to remember that. And I wanted to give you a little something extra this week because I felt that that was an important thing. And it shows you how companies gauge risks. So I really wanted to show you that. But the second part is actually what you'll be dealing with. And that's it. Enjoy your holiday weekend. And it's always a pleasure working with you. We got one more week left.